Over the next 12 months, the United States Treasury has to sell or refinance $8 trillion worth of government bonds. It is a staggering amount of debt coming due on a very tight deadline, and they need to find buyers for every single penny of it. But the usual safety valves are gone. Foreign central banks, which typically buy up our debt, are actively replacing their U.S. Treasuries with gold. The Federal Reserve could theoretically buy the bonds themselves by printing the money directly, but injecting that much newly created cash straight into the economy would risk severe runaway inflation. This leaves the incoming Federal Reserve Administration with a very specific vision to execute. They have to find a way to stimulate economic growth and absorb all this government debt, but they must do it without the visible money printing that traditionally triggers a crisis on Main Street. It is a brutal paradox. If the Fed openly prints money, high prices crush the public. If they do nothing and let the bond market fail, the government risks default. To navigate this, they are engineering a backdoor mechanism. This graph illustrates step 1. By lowering short-term interest rates, the Fed creates a steep drop on the left, while long-term rates remain high. For commercial banks, this vertical gap is a profit spread. They borrow cheaply to buy long-term treasury bonds, pocketing the difference. But there is a roadblock. Right now, banks are restricted by a post-2008 regulation called the Supplemental Leverage Ratio, or SLR. This rule caps how many treasury bonds a bank is legally allowed to hold. Currently, the banks are full. They cannot buy more government debt without violating these capital requirements. Step 2 is to permanently loosen or remove that SLR limit. Once those regulatory limits come off, commercial banks can immediately pile into the bond market using massive financial leverage. Enticed by that profitable yield curve, they borrow cheap money, buy the treasury bonds, and absorb the government's debt on a massive scale. The net effect on the bond market is identical to the Fed printing money and buying the debt directly. This process effectively launders quantitative easing through the commercial banking system, keeping the direct inflationary evidence off the Fed's own balance sheet. There's just one complication. Conflict in the Middle East, specifically around the Strait of Hormuz, threatens to shut down one of the most vital shipping lanes in the world. 20% of the world's oil moves through that exact choke point. If those lanes are restricted, global supply drops and energy prices climb. When fuel costs go up, the cost of transporting every good in the economy follows, which drives inflation higher. This graph shows what happens when inflation hits. Rising prices force short-term rates back up, flattening the curve and erasing the bank's profit gap. Without that spread, banks lose the incentive to buy government bonds, and the backdoor blueprint fails. Right now, the government is artificially suppressing those fuel prices by draining the strategic petroleum reserve. By flooding the market with these emergency oil reserves, they are keeping the inflation metrics calm enough for the Fed to eventually lower rates. But that strategy has a hard deadline. Current data suggests these strategic reserves will run dry in less than 80 days. Once that cushion is gone, oil prices will climb, inflation will rebound, and the bond market will face the full weight of that $8 trillion dead load. A stable Iran deal reopens the shipping lanes and cools energy prices, the final piece needed to keep the bond market from fracturing. This agreement is an emergency maneuver to ensure the commercial banking system has the environment it needs to absorb the Treasury's debt. Understanding these mechanics changes how you should view upcoming Federal Reserve press conferences. Moving forward, the immediate interest rate decision matters far less than the specific tone the Fed chair takes regarding the bond market. When the Fed describes inflation as transitory, it indicates they plan to proceed with rate cuts later this year. However, if they mention bond market stress or suggest the Fed has tools to support liquidity, it signals that the banking regulations are coming off and the money printer is warming up. These maneuvers are ultimately sophisticated ways to manage a debt burden that has become too large to pay back with existing tax revenue. To avoid default, the government must continuously expand the money supply to service what it owes. While the $8 trillion refinancing is a short-term crisis, the constant money printing required to fix it drives a much larger secular shift known as a commodity supercycle. History shows us that capital rotates out of paper assets, like stocks and bonds, and into hard assets for sustained periods of 15 to 20 years. During these phases, the money supply grows faster than the economy itself, making paper currency less valuable relative to physical things. This is why investors have historically turned to gold bullion to protect their purchasing power. Silver provides a similar hedge. As a tangible asset with industrial utility and a limited supply, it historically outpaces currency devaluation during these structurally inflationary periods. The headlines will stay focused on geopolitical friction and short-term jobs reports. But by understanding the pressure the Treasury is under to refinance its debt, you can see past the noise and position your portfolio for the real asset supercycle that is already underway.